Everyone, the movement in the U.S. gold market yesterday is something we really need to think about seriously. We all know that the recent surge in gold prices has been driven not only by increasingly chaotic global geopolitics, but also by the near shutdown of the U.S. government. But pay attention. Yesterday, something happened that should theoretically reassure the markets. The U.S. and China announced new trade negotiation results. Logically, this should boost global stability, since the content addresses the most heated disputes of the past. So how did the market respond? Gold didn't care at all. It didn't fall. It surged even higher. What does that mean? It means the market believes this round of U.S.-China communication is merely a tactical ceasefire, not a strategic shift. Just a brief pause. Uncertainty ahead remains overwhelming. The second signal, nuclear threats are escalating. Russia just conducted a nuclear test, and the U.S. responded by advancing its own nuclear programs. Combine that with worsening situations in Venezuela and the Middle East, global geopolitical risks are sharply rising. The reality is, today's global problems can't be solved by trade talks. What's truly driving gold upward is the deep geopolitical fractures. The third and most alarming point, the Federal Reserve suddenly announced a rate cut and will stop balance sheet reduction earlier than expected on December 1st. This move is far ahead of market projections. Why the rush? One reason, liquidity in the dollar system is extremely tight. Looking back to late October, 2 U.S. regional banks revealed fraudulent commercial loans worth less than $200 million, not a huge number. Banks and regulators said the cases were isolated, manageable, and not systemically threatening, nothing like the 2008 subprime crisis. But JP Morgan CEO Jamie Dimon warned us, if you see one cockroach, it's never just one. What concerns me even more is this. Powell kept insisting that the credit market is fine. The more someone insists nothing is wrong, the more people suspect something is very wrong. And on top of that, the Fed isn't allowing the $35 billion in maturing MBS to roll off. Instead, it will use the money to buy short-term treasuries. What does that look like? It's loading ammunition in advance, preparing for a potential return of QE, massive liquidity injection, next year. U.S. debt is already $38 trillion. No one truly expects the principal to ever be repaid. As long as interest is paid, everyone pretends it's fine. But interest costs are climbing rapidly. There's only one real solution: inflate the debt away. And gold's price movement is already warning the financial system. Danger is coming. We can't yet know whether more banks will reveal liquidity problems, but the Fed's actions show they know exactly what's coming. Otherwise, they wouldn't slam the brakes on quantitative tightening so early. Looking back over the past 100 years, whenever these conditions appear, geopolitical risks keep rising, inflation becomes harder to contain, globalization reverses and regional conflict intensifies. Gold becomes the most direct and instinctive safe haven asset. And U.S. inflation is still around 3%, far from the 2% goal. Despite persistent efforts, it's been very difficult to bring down. Finally, to those who want to speculate in gold short term, don't forget, the gold market is a playground for capital giants. The price charts? They draw the lines. Volatility will only get wilder. Risk will only hit harder. If you want to enter this market, you must understand the real logic behind it, not just walk in as someone else's pawn.